you're known for active management. American funds are famous for that. And these are all active management. But as we've talked about before, the bulk of the money in ETFs is still going into the passive strategy. Even now, in the first 6 weeks of 2022, the bulk of money is still going into passive strategies. Look into the future. Is there any consideration to getting into the index space where a lot more money, maybe it's not as profitable, but a lot more assets under management are potentially available?
Yeah, so I'm actually going to reframe your statistic because I think that there's a bit of a confounding effect here. A bulk of the money in ETFs, I believe, are going to core solutions. I think investors in the ETF vehicle are really looking for those core building blocks. A majority of those have been indexed. So certainly we've seen assets move toward index management, but I think it's investors speaking to where and how they want to allocate money versus the investment style. So when we think about Capital Group's 90-year legacy of delivering above market returns for our clients, we really believe that active management is at the heart of who we are as an organization. And that's why our entrance into the ETF marketplace is really squarely focused on active management and not index management.
Yeah, and Dave, I guess Holly's right if she considers like an S&P fund, a core fund or a core investment strategy, because that's where still most of the money is going at this point. Can you just characterize some fund flows for us in the last 6 or 8 weeks? Because I'm getting that question all the time. Where is the money going?
Yeah, so I mean, it has been going to that core, right? We haven't seen a dramatic shift here in the last 6 weeks that we saw last year. About 10% of the money is going into actively managed products. That's about what we saw last year. We're running at about something like 15 billion year to date into active ETFs here. So, really, I think this is a stick to your knitting kind of market where we've seen a lot of folks allocating in. We haven't seen really dramatic shifts in the flows picture that would make you think, for instance, that everybody's running for the hills or everybody's piling in and buying the dip. It's been pretty consistent. That actually, to me, feels very, very healthy.
Yeah, I think the important thing, Holly, is you are now firmly established in the ETF space, in that core space. And the question here is, now that you've got that core built around you, where else can you go? Are there other, I know I've asked you this before, but are there other ambitions? You're such a big company. It seems like there's natural room for you to move and breathe a little bit more here. Now that you've got these core ETFs that are out there, are you going to simply stick to that strategy and just manage those 6 right now? Or are you going to do like, Schwab did and others and just try to expand out from there and see what the market is like?
Yeah, so the 6 ETFs that we'll list tomorrow are absolutely our entrance into the marketplace, but this isn't where it ends for us. If you look across the services that we are launching in this initial suite, they cover a majority of the largest asset allocation building blocks, but not all of them. All of the equity services have a roughly large and mid-cap universe to them, and we only have one fixed income offering in this initial suite. So we anticipate, again, continuing to listen to feedback from our clients, continuing to take feedback now that we're out in market, and respond to investor needs. And so I expect that the product lineup will continue to expand, but we're going to take a very patient approach to that and ensure that we're incorporating new product development with the lens of an investor in mind and incorporating their feedback.
And how do you respond to this age-old debate of active versus passive? We all know the studies. We've seen the S&P studies that come out, the SPIVA annual reports, that over long term, most active fund managers do not outperform their benchmarks, certainly over long periods of time. 10 years, 85% don't outperform. Well, what do you tell the naysayers? You're famous for active managers. You've been around a long, long time doing this. What do you say to the naysayers who say, well, frankly, the evidence is just staying in the index fund is probably a better long-term strategy? How do you respond to those arguments?
I think there are a lot of valid ways to invest, and Capital Group, with our fundamental bottoms-up selection process and our multiple portfolio manager system, has a 90-year legacy of delivering superior investment results for our clients. So I think our track record really speaks for itself, and that is why we have a loyal investor base of $2.6 trillion of assets under management. So I think there's a place for both active and index in a portfolio, but really at its core, we believe that we can deliver actively for our clients and have a track record of doing so.
Yeah, well, Holly, and Bob, remember, we've got 800 actively managed ETFs now, right? I mean, that ship has long since sailed. It's roughly a quarter of the industry.